So, inflation cooling on a headline level, if still elevated. The shelter index is the largest contributor to that number. Shelter rising 0.4% in April, and it's up a whopping 8.1% on an annual basis. For more on this, we turn to Brad Dillman, Cortland chief economist. Brad, thank you for joining me this morning. So, as we mentioned there, when we think of how much shelter, and especially rent, makes up in this CPI data, I mean, a slower increase than some were expecting, but how would you characterize where we are in terms of rent prices?
Well, I think it's certainly good to see it finally tick down a little bit. I mean, the number's still high. That shelter inflation print is the first time it's really gone down since it started to increase in early 2021. As for how I would characterize rents, look, annual rent growth has been slowing since the summer of last year. But of course, there's plenty we could say about where it may go in the future, too.
Indeed. And one thing that's interesting, because you talk about how you characterize the methodology of how these rent increases are calculated in the CPI data. And you say there's actually a better way to calculate it that would better reflect what's actually happening with some of these rent prices. Break that down for us.
Yeah. The Cleveland Fed put out a great paper where basically they replaced the rent component and the shelter component of inflation and basically replace it with a new lease rent growth index. So it was not just renewal leases and new leases, it was only new leases. And what we can see is that in the rental market, this is where rents are set on the margin, right? New leases tend to flow to renewal leases. And basically, their study concluded that inflation would be a lot lower if one only looked at new lease rent growth, because that had been slowing for much of the second half of last year and even into the early part of this year. So by that measure, inflation is actually lower. On the flip side, if we were to look at our own data at Cortland, where we're seeing new lease rent growth, it looks like it could start to tick back up again.
So with that in mind then, looking at your calculations then, has the Fed over-tightened at this point then?
Well, so I think that's basically what the Cleveland Fed was suggesting, that maybe that was the case. At this point, no, it wouldn't look like that at face value. I mean, the CPI print is still coming in very strong. I think even if you do replace it with this new lease rent growth index, as the Cleveland Fed did, and you see new lease rent growth occurring as we have over the last several months, you see an indication that you may see a return of inflation, and therefore that makes the case for a higher for longer. Not necessarily a Fed funds rate at 5% in perpetuity, but not going back to zero either.
And for a lot of people out there wondering why their rent is still so high, I mean, there's a number of factors at play. You had excess housing starts when the pandemic first set in and people were sort of rushing, at least they thought, to build more houses. And then you have inflation, you have the cost of materials, cost of labor, and we'll get into labor in a second. But I mean, you also have existing homeowners that just aren't incentivized to sell if they're going to take on a higher mortgage rate. How much longer do you think we're going to continue to see rents so high and so sticky?
Well, given that it's been inflation and that we are seeing it in wage growth, now granted, wage growth hasn't really kept up with inflation, but there's certainly some wage growth out there, that we're not necessarily in for sort of an outright deflation in the rent level. If we look at how rents have moved around the country, say over the last 6 months, there's only really a handful of markets where the rent level itself is down, over the last 6 months. And in annual rent growth terms, there's even fewer where it's actually negative. So rents still look like they're going to be quite strong. When we look at why they got so strong in the first place, we really look at the eviction moratorium. It created an artificially tight occupancy rate, which translated to an artificially high rent growth rate. Now, there may have been perfectly justifiable reasons for that, but those do have a consequence in the overall market. In fact, we concluded that about 300,000 units nationally had been taken offline. That's the equivalent of the conventional multifamily stock of metropolitan San Diego. So it was a lot of supply basically held off market that caused rents to shoot up. We have seen supply start to come as a result of that, right? Particularly back when rates were lower and a lot of new development projects penciled really well.
And as we look at some of these areas where we're seeing on a monthly and an annual basis where the rents are still rising versus where they're going down, one interesting issue that you highlight is what's happening with the labor market, an expanded labor market with perhaps more immigration coming in, stronger employment outlooks. How does that factor into what we will see with rent prices?
Well, it's two-sided, right? So when we look at the scale of immigration as it's been over the last few years, that's going to be a lot of housing demand, right? Multifamily demand or even for purchase housing demand. On the flip side, it's going to expand the labor market too. That should be disinflationary on the wage growth side, as we've already seen, and that's economists speak for basically a slowing rate of increase. So on the one hand, you're getting a lot more demand, and then on the other hand, you're getting some pressure on the labor market that may also mitigate the strength that we have seen in the labor market already. It allows for more jobs, but it may not necessarily translate to incremental wage increases and really define the picture coming out of the pandemic initially.
We'll certainly continue to keep a look at that. A big thank you to Brad Dillman there for joining us on Yahoo Finance this morning. Thanks so much.